The Fed pivot is finally here, but not in the way that you might be thinking. No, the Fed hasn't come out and said that they're going to start reducing rates, but what they have said leads the market to believe that they're not likely to do additional rate hikes, instead believing that restrictive policy staying in place for a longer period of time is going to give the market exactly what it needs. One of the biggest changes that's happening in the market at the moment is that we're seeing bond yields surge on the 10-year, hitting just over 4.8% last week, coming off stronger than expected PPI data, with consumer prices rising 0.4% in September, which was more than expected. In addition to that, we saw job openings top 9.6 million jobs, which was significantly more than the market had anticipated, on top of jobless claims staying below 210,000 for 4 straight weeks. And one of the analysts that I follow believes that we need to see jobless claims average somewhere around 323,000 jobs on the 4-week average before the Fed starts reducing interest rates. And with us currently sitting at 210,000, we're a very long way from that point. But the good news is the Fed officials are likely to keep the pause going due to this surge in bond yields that I was just talking about. With bond yields topping 4.8%, we saw mortgage rates near 8%. And then we saw a bit of a retracement due to a war breaking out in the Middle East. And the primary reason for that is because Treasury bonds are typically a safe haven for volatile times. So when you see wars happening in different places of the world, people typically take their money out of the stock market and put it into bonds because it's a safer investment. And while we didn't necessarily see money being pulled out of the stock market because the stock market continued to do well, we did see 10-year treasuries retrace a little bit, which in turn has allowed 30-year fixed rates to get back below 7.5%, which we recently saw for the first time since 2000. At the moment, we still have mortgage rates sitting near 23-year highs, along with home loan applications and mortgage demand sinking to the lowest level that we've seen since the 1990s. And the main reason for that is because we've seen the average US mortgage payment skyrocket nearly 46% in just 1 year. So I started the video saying the Fed pivot is here, but you're probably listening to this going, Jeb, this is all really, really bad news. What do you mean the Fed pivot is here? Well, as I mentioned, the Fed pivot is more in their comments, with some of the more hawkish members now having a more dovish stance, believing that this rise in bond yields is actually doing a lot of the work for them without them having to raise rates additional time. While former Dallas Fed President Kaplan believes that inflation is going to be sticky somewhere around 3%, we have Fed Governor Waller comparing the run-up in Treasury yields to the bank stress that we saw back in March, saying that now, once again, financial markets are starting to tighten up. On top of that, you have Fed President Logan saying that higher yields may mean less need to raise rates. And then you have Bostic saying, I don't think we need to increase rates anymore, saying that the economy is clearly slowing and a lot of impact is yet to come. And in my opinion, that's the most logical comment that any Fed member has made in the past 12 months. And lastly, you have Fed President Daly saying that the rise in bond yields builds a case for the Fed to hold rates. And with all of these comments, 85% of interest rate traders are betting that we won't see another hike in November and a 74% chance that we won't see another hike in December. On top of that, they're pricing in rate cuts starting in June of 2024. So even though a lot of the Fed members believe that the recent rise in bond yields is doing a lot of the work for them and believing that their current policy is sufficiently restrictive, they're still paying attention to inflation, which is one of the primary things that the Fed has been trying to tackle for the better part of 2 years. That's why they started hiking interest rates to start. So even though we saw consumer prices rise 0.4% in September, there's actually a positive spin on that data once you take out shelter. So as we've discussed in previous videos, shelter is a 12-month lagging indicator, with the current reading sitting at a 7.1% increase year over year. But once you start to look at the month-over-month national rent index, we can see that 6 out of 12, half of the past 12 months, have actually seen negative price drops. And as we continue into the fourth quarter, we're likely to see this accelerate. And if you actually strip shelter completely out of the CPI data, you'd have CPI running at its 2% target. But as we know, core CPI still remains more important than headline CPI. And the past 2 readings have come in 0.3% month over month. So if you annualize that, that's a 3.6% reading on core CPI, which is significantly higher than the Fed's 2% target, which means that we need to start seeing some 0.2% or less in order to get back to that target anytime soon. And while I do see inflation moderating and I do see the Fed pivoting by pausing rates, not reducing them at this time, I believe that we're in a new environment for the housing market. Even though home prices are up despite higher mortgage rates, we're starting to see more sellers drop their asking price. And that's because mortgage demand is sitting at the lowest level since 1996. So even though there's not a lot of inventory in the market, there's also not a lot of buyer demand out there either, which in turn means if you have a house sitting on the market and you have to sell, the very first thing you have to consider is reducing that price in order to get more activity on that property. And while I do believe inflation is going to continue to moderate, there's also an opportunity for it to also stay higher for longer, a lot like the Fed funds rate. And that's because there's a chance that we see oil continue to go up because of the war in the Middle East, along with a possibility of some wage inflation out there due to the large amount of job openings in the market. So this new housing market that I'm talking about just means less activity actually happening as rates stay high, demand stays low, along with a lack of inventory coming to the market because so many people have locked in low interest rates. Now I know there's people out there that believe inventory is going to increase as more and more people get laid off from their jobs and the economy starts to slow. There's also a portion of people out there that believe there's going to be a bust in Airbnbs and short-term rentals, and all that's going to come to the market. Now, I don't believe that to be the case. In fact, I believe that inventory is going to be a bigger problem for a longer period of time because of so many people not wanting to give up that low rate, even if they're in a position where they feel like they need to move. The San Francisco Fed recently suggested that Americans have burnt through 90% of excess savings amassed during the pandemic, and that it would all be completely gone by the end of September, which is already passed. So if that is actually the case, then that means less discretionary spending out there in the economy, which should allow inflation to continue to moderate. In addition to that, shelter should continue to ease, which again should allow inflation to move lower. But if you're a buyer or a seller out there in today's market, I wouldn't be trying to pick the top or the bottom in the market. I would be doing what was right in my life at that time. And the primary reason for that is that old saying that the market can stay irrational longer than you can stay solvent. So even though I'm giving you data here to back why inflation should fall and the Fed should back off, there's also an opportunity that that doesn't happen. So just make sure if you're buying in this market, you're buying for the right reasons, you have money in the bank, and you have a longer term time horizon. And the last thing I want to say is for any of those out there suffering in the world right now, my thoughts and prayers are with you and your family.